Thank you, Allison. It's always fun to work on a program with Mark. If he doesn't get you inspired, I'm not sure quite who would. You can either be inspired or motivated by a couple of different methods, and I think he hit on both of those. Just a couple of things. One, in the way of follow-up, for those of you who weren't following all the language that he was using but are interested in it, we have some workshops on managing margins. It's a computer workshop. You can practice and play, locking in hogs, locking in corn, locking in meals with all the different tools. And check with the folks upstairs in our extension booth. There's some of those coming up in February, so I encourage you to take a look at that. The other thing I would say is, and some of you have heard, I'm changing jobs. This is my farewell song here today. This will be my last presentation as a livestock economist. Monday, February 1st, they suck my brains out and make me an administrator. So I'll be a dean. The crush margin I'm going to show you are estimated return series that date back over 40 years. The Iowa Farm Outlook newsletter where we do price forecasts and so on will continue. Shane Ellis that works with me will be maintaining those and kind of keeping the fires burning. The basis estimates, all of those types of things. We hope to be able to hire another livestock economist at Iowa State. So stay tuned on that. But a lot of our mainstays will continue. What I want to talk to you about today is this crush margin. And this is a term I think that Mark dropped on either here or at the Minnesota Pork Congress a year ago that was just never mentioned in hogs, and then all of a sudden everybody was talking about it. And nobody knew what the hell it was, but boy, they were using the term. And so we went back and tried to define what a crush margin is. Can we calculate it? How does it perform? How would you use it? What does it do for you? And try to put some parameters on it, at least kind of according to the book of John. So this is kind of my way of calculating the margin and a way to think about it. And so we'll go through some of that. And the one I'm referring to, if you just go to our Iowa State page, in fact, if you go to Google, you can find anything, but just type in crush margin Iowa or crush margin Lawrence, and it will take you to our page. So the term crush margin comes from the soybean processing industry, where you get soybeans, you crush them, and you get oil and meal. And for a long time, traders have looked at the relationship of those three, all of which have had futures contracts, and they look for opportunities when one of those or two of those kind of get out of line as a place to put on a hedge. What we're looking at, and it's a single measure that captures the most volatile variables in your cost of production. All right? And that's what we're talking about, is managing the risk where the risk lies. We're not talking about managing the risk of labor cost, managing the risk of interest rates, managing the risk of propane. We're talking about the hog and the feed. And if you can get a handle on those, you've reduced the majority of the price risk in your operation. What's left over, the way I define it, what's left over, you have to have enough there to pay all your other bills. And we'll talk about that, of how big that margin needs to be. So my definition is simply the value of the hog less the cost of the pig, less the cost of the corn and the meal. Now Mark had all other costs on there on his margin, but I'll show you how we approach it. So for you mathematically and algebraically inclined people, we're simply taking 2 times the live hog futures at the time we're going to sell the hog, so a 200-pound carcass. We're subtracting the price of a weaned pig 5 months earlier. Not 6, not 5.5, not 22 weeks, 5 months earlier. 10 times the bushel of corn, 5 months earlier. And 150 pounds of soybean meal, 5 months earlier. So essentially, in my simple world, we sell a hog with a 200-pound carcass. 5 months earlier, we buy the pig, the corn, and the meal all the same day. So that's how I'm defining it. All right? So prior to placement time, prior to the time you buy the pig, what we're tracking is a live hog futures. Pig price is a function, I'll show you that ratio, a function of the lean hog futures. Corn price, soybean meal price, those are all the futures adjusted for basis. And in our model, we use Iowa Southern Minnesota hog basis, North Central Iowa corn basis, Iowa soybean meal basis. The pig is priced at 50% of the 5-month out future in my model. Now you guys all say, wait a minute, it's supposed to be 52, 53, 54, whatever your number is. Well, I went back and checked, and prior to September 1st of 2006, sure enough, it was 54 or higher. From that September 1st of 2006, when corn went north, pig price went south, and that had been running much closer to a 50% on average, and so that's our number. And what I'm going to tell you as we go along is our number is meant to be just a flag, just an indicator. You still have to go do your homework and make the adjustments. If you've got a different carcass weight, a different pig price, a different basis, what we're going to do is just help you look a little further down the road. At placement time, so 5 months prior to slaughter, then we, on the case of the pig, we price it off the LS 255 sheet. So the cash price for pig, we plug that in. We go to the North Central Iowa corn price. We plug the cash price of corn into our margin. We go to the USDA report on Iowa soybean meal price, and we plug that in. So at placement time, we switch from using a futures to estimate those inputs to the cash price. And then we track that margin going on using the lean hog futures adjusted for basis for the hog part. Okay. So here's our reports. We use the 204 on hogs 5-day rolling average, weighted average price. It's got the discounts and premiums in there. The LS 255, 10-pound pig, 54% lean. It's that category. But the 750 head are larger category. And then here's where we get the soybean meals, the GR 850 report, and North Central corn. So what's not included in my margin? Well, everything else. On our estimated return series, another profit estimate we do every month, we've got these other costs that are not included in what I just showed you. So I got vitamins, minerals, the purchase of complete feed like pig starters and so on. It's about $11.35. I got grind mix deliverer, the vet med, the labor, interest, on down. So I need about $40 to $41 left over in my crush margin just to break even. So as I'm tracking that margin, that's the lean hogs minus the corn minus the meal, I need that number to be over $40 if I'm going to break even. So that's the way I track it. There's other adjustments. So we got the non-feed costs. We just looked at those, and your numbers will differ. Right? Of how much you're paying for grind mix and deliver, how much you're paying for facilities. Your bushels and pounds may differ. So I got 10 bushels of corn, 150 pounds of meal. That's nice round numbers in a 200-pound carcass. You may say, well, I've got 205 and 9.5 and 100 and then 100 pounds of distiller's grains. Fine. I think our series is just being an indicator of when there may be some profits, and then go do your own homework. I think it still has some value, but you need to make that adjustment for yourself. One simple way on, say, the distiller's grains is you do the math and you say, you know, when I switch and put this distiller's grains in, it saves me $4 a head. Okay, take my number where I needed $40 profit or crush margin to break even, you now need 36. The math is pretty simple. Okay. Basis may differ, and as I say, you got to do your own calculations, but just use this as a flag. So what's it look like? All right, every Wednesday on the close, Wednesday closing prices, so I'll do it this afternoon or tomorrow morning before the market opens, we go ahead and calculate going out here, this margin. We go all the way out here. These are pigs placed in January of 2011, sold in June of 2011. So we're not looking at the pigs in the barn. We're looking as far out as the futures will allow us to go. Remember my $40 mark here? That's kind of the break even. So that says, with the exception of here maybe pigs placed in June, July, August, all of these others are break even or better going on out there on that day, January 13th. So this is a couple of weeks old. The one posted today would show what happened on the 20th. The one that you guys will see tomorrow morning will show you what was on today's close. But it's an opportunity then to look what's going on. The first 5 here are pigs in the building. I guess I got 6 up there. January's now done. Then you got the next group that'll be coming in, and the next group, and so on. And then we track those. So we take each individual and we track them over time. So for example, this pink one up here at the top, that's the May 2010 marketings. But I can go all the way back to January of 2009. A year ago, I started tracking the margin on that pig that's going to be sold next May. And it was up here over 50 bucks. It got down below 40. It come back around 50. So the point being, you get a snapshot with this one. What's the market telling me today going out into the future? If I'm interested, I can go back and I can find, okay, how has that been trending? Is it getting worse? Is it getting better? What's going on with that margin? And I do that for, this is for the ones coming up that are in the barn now. I've got 2 more graphs on that page that show the ones that aren't even placed yet. But again, I can begin to pick up the trend. What's going on with those? That's on that same website. How would you use this? Well, if an opportunity exists, our flag goes up that says there may be a profit out there in a few months. You do your homework, says, yeah, I think I'll take advantage of that. How would I do it? Well, you'd want to sell the lean hog futures on 80% of what you, this is if you wanted to be 100% covered. You can back that off. And let's think of a simple case of a 1,000 head building, round numbers. I'd hedge 80% of the lean hog futures, and I'd buy coverage on 100% of my meal and my corn. Okay? I'd leave 20% open on the lean hog futures because that matches up with the pigs I haven't bought yet. So that if pig prices go up, so does the value of that 20% of the cash hogs that I haven't covered yet. If pig prices, futures go down, yeah, those 20% of the futures went down, but so did the price I pay for my pigs. Because remember, at least in my world, I'm pricing pigs tied off that 5-month out futures. Yeah, there's a spot market for pigs out there that doesn't behave exactly like that. But in general, that pig market's tied fairly closely to what that futures is. Maybe not lockstep. Maybe some of you are on formulas that are perfectly lockstep. But you leave part of that open. And then at placement time, I buy the cash corn, I buy the meal, I offset their futures position. I go ahead and cover the remaining 20% of the hogs because I just bought the pigs as well. Now I'm 100% hedged if that's what I wanted to do. And then I go ahead, carry the hogs on to slaughter, find the time to lift all the hog futures. So that's how you would use it. How has it performed? This is one of the other things we do, and we have about a small paper explaining it. We went back and looked at how this, if you'd use this, how it performed over the last 10 years. And so this is crush margin on wean finish from 99 through 2008, averages by selling month. And so across here, January selling month, the average margin, that crush margin that I calculate, averaged $37.96. Remember, I needed $40.48 to break even. So on average, across about a 15-month period before that pig dies, that's what it averaged. At placement time, over that 10-year period, so there's 10 numbers going in that, placement day, it averaged just right at break even, $40.93. And if I didn't do anything and I went to the very last day, which is essentially staying in the cash market, it averaged 42. So right there, everything Mark told you has been a lie. There's always more money if you stay in the cash market, right? You know it. Now, this, what that says, that on average, if you take the risk, on average, those prices were higher. The thing I notice is back here, if you look at the range from high to low of what happened to that crush margin, while we may have ended up averaging 42, there were opportunities as high as 55 in there as well. Remember, I need 40. It got as high as 55. That's 15 bucks a head. And you can look down through these months. Let me go ahead and hit my little bars here. there's quite a range from high to low that says year in, year out, there are opportunities offered on these margins. The other thing to note, you can see these little green boxes show up on here. So for example, July placement time, for example, averaged higher than the last day. So it would be July marketings. Summer month, you never have to do anything because it always takes care of itself, right? Except if you'd made the decision at placement, it ended up higher on average than doing nothing. If you look at the fourth quarter, October, November, December, placement averaged higher than the cash market. If you look over here at the average, if you just hit the average on the crush, it did as well or better than doing nothing as well, let alone where some of the opportunities lie. And again, this table in the paper is on the website. Another way to look at it, for those who are into pictures here, this is the percent of time, and this is in table form in our paper. But this would be out of that 10-year period, and you look at, 14 months worth of trading. You got a certain number of days, 250 or more trading days. What percent of those days were either $50 or higher, 40 to 50, 30 to 40, or under 30 over that 10-year period by month? So for example, June and July, there's very few times the crush margin ever got below 30. So if I was looking at the crush margin for June and it was offering me $28, I probably wouldn't jump at that one, right? There's about a 98% chance it's going to be better. But if I'm over here at, let's say, November sales, and there's only been about 15% of the time it's been above 50, and if I could get 50 on November, I'm probably going to take that one. Because there's an 85% chance, at least based on history, it'll end up being below that. So you can kind of look at different months, what is been historically a good margin. And Mark talked about having some benchmarks as part of your plan. You've got some goals. What's your margin goal for the summer sales probably shouldn't be the same goal as you have for your fall sales. You need to adjust those marketing plans. So, summary, crush margin is just a way to focus on the risky variables that you manage. You guys manage production, you manage labor and people and all those things all the time, but let's focus on the price risk variables, and that crush has all four of the ones that can change on you. It keeps the focus on the margin, not just the price, and that's particularly important for those of you buying your feed inputs. Our margin indicator, as I said, is calculated Wednesday. We are talking with, in fact, the University of Illinois approached me with their farm.doc, or farmdoc.com, I think it is. Anyway, the farm management website in Illinois says, hey, that's a pretty slick deal. How about if we work with you and come up with a daily margin? And what they're trying to do is tailor it so you can go in and put in your own cost, your own bushels, and so on. And then anytime you go to that website, it will go out and pull up the appropriate futures and bring them in. I'm not smart enough to program the web to go find the futures price and stick it in the right hole, but they're working on it. To my knowledge, it's not done yet, but when it is, I would definitely bookmark that page and put your own variables in, and then anytime you want to check the market, you can just click on that and it will pop up what's out there. We update these manually every Wednesday. Again, it's just a flag. Okay, I think I got a little bit of time. Let's shift gears here, and I'm not going to try to steal anything from Steve Meyer. He's got your outlook tomorrow. I want to take this crush margin, which has been buying weaned pigs and going to finish, looking at now farrow to finish, but using the futures looking forward, what I'll call the kind of the good, the bad, the ugly scenario. And this feeds back into what Mark talked about going as we look forward. One of the things, and this is by way of, I don't know, apologizing or covering my tail or whatever, but we've come to realize, as you folks have as well, supply is a very poor predictor of price. You go back 10 years ago is pretty simple. You guys cut production, your price is going higher. And if that was the case, you would expect a line something like this, that if we increase production, this is percentage change from the year before, quarterly, so if we increase production, we'd expect lower prices. If we decrease production, we move back to the left, we expect higher prices. And that used to be a 3-to-1 relationship. Very predictable. And all those dots are supposed to be right on that blue line. How do you account for these? We increased production and the price went up. Right? We decreased production and the price went down. That's that effect of exports that are such a big part now. We're up, last year we were 20%, or 2008 we were 19%. As exports become a big part of your demand, it doesn't matter necessarily what your supply is. And this goes back to this idea of you now have a more risky environment you're dealing with, because you can't just look at the hog and pig report or say that we've got a shortage because of weight or disease or whatever it is and try to outguess the market. If you get a stroke of a pen halfway across the world that says we don't want your product, it impacts price. And those are very, very difficult to predict. So with that as a backdrop, that we're in a more risky environment, let's take a look at what the futures are telling us today. And I'm a believer that futures are a composite forecast. Everybody who's willing to put their money where their mouth is have voted on what hog prices will be into the future. The Glenn Grimes, Steve Myers, myself, Chris Hurt, the private analysts out there that are all doing this, if we were really, really good at it, we probably wouldn't share it with you, right? We'd be phoning in from Boca Raton or something like that. So what are the futures telling us? And I did this morning, so this is yesterday's close. What are the futures telling us? The red line up here is 2009, the blue line is 2008, and the green line is the futures price adjusted for the previous 3-year average basis for next year. And on average, that says 21. Actually, yesterday it was 19% higher. Yesterday's price forecast for the 12 months in the future is forecasting price is 19% higher than 2009. So we're going to get a price increase. I think we all agree with that. And currently, the current thinking is it'll be 19% higher. What if they're wrong? Okay? This is our estimated return series for all those that you were reading that you guys have lost $4.5 billion since October of 2007. Folks took my numbers, our estimated return series, multiplied it through by head. I took that same model and said, let's break it out. So the blue line here is feed cost. The purple line, variable cost. Green line is total cost. Red line is price. So red above green is profit. Red below green is loss. The vertical line there should be right at January. So January back, we're fairly confident in those numbers. They're history, right? The ones going forward, we use last night's futures price adjusted for basis on corn, meal, and hogs. And what that says is we're expecting to be at break even here in February. January was not quite there, but close. February, March will be a break even. The summer months should be profitable, back in the black or the red, perhaps in the fall. That's what the futures are telling using our cost structure. What does that mean as far as Mark's concerned here on an equity position? Well, I took this top line up here is kind of a track on equity, if you will. And you go back January 2006, I said if you started at 0, so think of a cookie jar sitting on your kitchen counter. Every time you sold a hog and made a profit, you put the profit in the jar. If you had a loss on that hog, you took that much money out of the jar. And if you started with an empty jar in January of 06, you had an empty jar in December of 08. Okay? The trouble was the fund didn't stop in December of 08. It just kept going down here, and then this is the projection going forward. Now, we kind of hold it together, but don't really rebuild a lot the coming year. given on yesterday's market prices. Now, it depends on when your cookie jar started. If you look at this lower graph, the blue line is the same one that you see above. The purple line is the guy started with an empty jar on January of 04. Experienced some better times. They didn't have circovirus in this example, right? But the point being, you got to where we are now. If you started with more cookies, you still got some money to kind of piss away over the next few months. But let's go back to what Mark said. This is one of those things. Maybe it is a size issue. Those that were specialized only in hogs, buying all of their grain, highly leveraged because they were in a growth mode. Which curve are they on? Those that have a land base that produce their own grain, that's been at this for generations, that had equity in the operation, which curve are they on? Okay. I think the pendulum has swung back to our more diversified farms. Okay. And that's, I just tell you that as a sidebar here. So given that, and I would call this the bad scenario. 19% higher prices, but we really don't fill that hole up very fast that we dug ourselves going forward. What does a good scenario look like? And I just made this one up, but let me tell you what I did to make it up. As I said, what if yesterday's hog prices were wrong, and then, in fact, starting with February, they go up 3% from what they were yesterday. And then the next month they go up 6%, an additional 3%, an additional, for 5 months they end up going up 15% higher than yesterday, and they stay there the remainder of the year. That gets us to 2010 being 33% higher than 2009. Now, why did I pick that number? Well, 2 times in the last 20, we've seen a 33% increase in hog prices, annual average hog prices from one year to another. So it can happen. It has happened. It can go higher than that, but I'm saying those are marks we've hit in the past. We have profits in the summer. We get up there, cash price above 60 through the summer months, stays profitable through the fall, and we recover, if you look at the lower graph, we recover about 2/3 of the equity that was lost in 2009. Not all of it, but we recover about 2/3 of it by the end of the year. Okay? So if that's a good scenario, what's ugly look like? Well, let's first off, what would it take to give us good? Compared to yesterday, we would have to have exports stronger than what they were thinking. So it's a weak dollar. China comes back in the market. Russia has resolution, and we begin and continue trading with them. We'd have to have the recovery stronger, maybe additional stimulus package. Obama's going to talk about some things tonight. Get the economy back going. Worldwide economy would have to pick up. Maybe even a little bout of inflation to help commodity prices. Supplies would have to be smaller. We would have to have had some bankruptcies that we don't know about in the marketplace. Remember, this is compared to what we know yesterday. To bring supplies down, or disease problems, or we idle some facilities compared to what we know today. I put this one together, I started back in December, and I said, you know, the smaller supplies, packers just battle it out, and the basis improves because there's less hogs, and they really fight it out. I'll show you in a couple of slides the flip side of that. And there was talk a couple of months about the traders just saying, man, if there's inflation, the only safe place to be is in commodities. And so what if you get a lot of speculators coming into the market, and that drives the price higher? All of those things can contribute to higher prices than what we knew yesterday. So if we had bad where we started, this was good, what's ugly? Well, ugly, I said, what if hog prices decrease 1% a month for 5 months and end up 5% lower than we thought yesterday? They still end up being 15% higher than a year ago. So if you look at it, hey, it's higher prices than 2009. We get up here into the profitable situation in the summer. We go back into some losses in the fall. The problem, and why I call it ugly, is the equity just continues to disappear. We don't fill up the hole that we've dug. Okay? It just continues to drain. What would cause ugly? Well, the flip side of what would cause good. And I apologize I didn't update that slide there. But compared to yesterday, exports are weaker. Do we get a double-dip global recession? And so their markets. Do we have a stronger dollar? The recovery is weaker. Again, a double-dip recession. And the stock market here recently being weaker has some people concerned. December housing sales was well below expectation. So there's some nervousness out there. Supplies are larger. Not that this would ever happen, but now that people are actually starting to cash flow a little bit, maybe they don't get out of business. Maybe they aren't forced into bankruptcy. That would never happen, of course, but what if that was the case? That supplies don't continue to fall back. What if packers, instead of fighting over hogs, close a plant? Not that that would ever happen, but what if they did? And that basis, instead of getting stronger, gets weaker. And what if the speculators give up the fears of inflation or at least find some other commodity to go into? This would give us that conditions where prices were weaker than we thought they would be on yesterday's close. Don't forget the cost side. This last little analysis we talked, feed cost volatility continues. We're going to hear the rest of the winter about corn quality and whether that January 12th report was right or wrong. There's going to continue to be volatility. You get the same ugly impact if feed prices go up 2% compared to yesterday as you do if hog prices go down 1%. You get the same ugly result. The other thing to watch, and I've been preaching this for a long time, kind of like Elwyn Taylor and his droughts. Eventually I'll be right. Okay? What happens if we do get a bout of inflation? How does the Federal Reserve attack inflation? Higher interest rates. Does any hog producer have more debt than they did 2 years ago? Right. Some of it's a line of credit that's variable rate, and right now that doesn't look too bad. What happens if those interest rates begin to increase? So I would be looking for a strategy of, can I roll some of that into a term note of some kind, lock in a fixed rate as soon as we see any signs of inflation? Because I think there is a risk there. All right, so just to summarize what we talked about, supply is a poor predictor of price. Undoubtedly, if we cut supplies, we'll have somewhat higher price, but not if our exports disappear. So they're still at risk. Demand and those exports are fickle. As I said, we're currently forecast to have about 19 or 20% higher prices. And if we get that, that would, if actually that's what's expected, if we have a record one-year increase, 33%, that ties the previous records, we regain about 2/3 of our lost equity. Not all of it. Remember, if you're betting to fill that hole in 1 year, it's never happened before. Okay, those are the odds that you're talking about. 5% lower prices, however, and we don't start to fill the hole. So that's the kind of risk. And I think going back to what Mark said, taking those opportunities when they present themselves, even though your mindset is, in the old days, the deeper the hole, the higher the high, I've got to be here for that home run. These aren't the old days. We have excess capacity in the pork industry. Given the higher cost of production, unless we grow exports, we will have a smaller pork industry in the future. And that's not just less sows. It's less finishers, it's less packing plants, less feed mills. And so when we rebound, we've got the capacity already in place to stay in business and keep those prices from going higher. So something to watch about. So I'm going to quit. I'll leave you with a quote from Earl Butz. Maybe you remember Earl Butz out there, all right, former Secretary of Agriculture. Some of you have seen this before. He says, it's better to be a mile from hell headed out than it is to be 100 miles out headed in. And I think the hog industry is headed out, okay? We may be circling purgatory like a NASCAR, but for the most part, I think it will get better. And so with that, I'm going to quit. Allie, I'll turn it back over to you.